Hello everyone to AT&T Intrinsic Analysis video from Learn.Invest.Achieve channel. The goal of this channel is to make investing more understandable and accessible. And in this video, we will learn why in my opinion AT&T is in a turbulent situation that is causing the market to undervalue the stock, which might be a good time to introduce this stock to your portfolio. But first, I want to remind you that this video is not financial advice and is for entertainment purposes only. If you are new to this channel, I want you to know that we depend only on the 10K or the annual reports when conducting this analysis. So in this case, we are using the annual reports from 2015 to 2022. These reports are filed by AT&T with the SEC because AT&T is a publicly traded company, and you can download these reports for any publicly traded company from the SEC website directly by using the ticker symbol. And I suggest that you do that and read them in your free time to learn more about your investment choices. Because these reports have so much financial and non-financial information that help investors to make an educated decisions. And in this valuation report, I collected the financial data from all three financial statements that are included in the annual report that I just showed you. The ticker symbol for the common stock is T, and they have three preferred stock classes, A, B, and C. And if we take a look at the 2022 annual report, we can see that there are a few publicly traded notes as well. Going back to the valuation report, the company reports its operation in a calendar year that ends on December 31st, and the auditor report about the 2022 financial statements is good, so we can assume all the numbers in the financial statements are correct. Now, the first thing I want to mention about AT&T that I believe is causing the market to undervalue the stock is that in 2018, AT&T bought Time Warner Inc., which is an entertainment company, and this new acquisition is reported in the annual report as Warner Media segment. But after a few years, AT&T realized that this acquisition wasn't the best direction for the company, so in April of 2022, AT&T separated this segment into a new publicly traded company and gave each AT&T investor about 1/4 of the new share for every one share they own. In other words, if you had 100 AT&T shares on April of 2022, you would receive 24 additional shares of this new publicly traded company that they created from the separation of the Warner Media segment. The name of the new company, if you want to look it up, is Warner Bros. Discovery Inc., and the ticker symbol is WBD. In my opinion, this process of acquiring an entertainment company by a communication company and then reversing this acquisition makes investors and potential investors think twice about the leadership of AT&T and the direction that they are taking the company. So there is a valid question on the table. Is the leadership going to grow AT&T or take one step ahead and then one step back? And in my opinion, this uncertainty is the first reason why AT&T is undervalued. Now let's go over the valuation report. And I want to mention that 2022 financial statements do not include Warner Media segment because it was sold in April of 2022. And for comparability reasons, the company removed this segment from the 2021 and 2020 financial statements, so investors can easily compare the operation performance between 2020, 2021, and 2022. So we start by looking at the 2022 revenue, and the biggest segments that make up this revenue are 52% from the wireless services, that are the mobile network coverage and equipment, 18% of the business services, that are the Ethernet fiber services and equipment, 8% broadband, that is residential fiber connection and legacy telephone communication, and finally 19% for other equipment. And if we scroll down, we can see that about 96% of the revenue is generated from the US market, and 2.6% from Mexico, and very small revenue from other countries. Moving on to compare the revenue and the main expenses year over year, we can see that when comparing the revenue with Warner Media segment, the revenue started decreasing in 2020 and 2021, which is an alarming thing for any company because, as we all know, investors want growth in operations that result in revenue and free cash flow growth that would eventually reflect on the stock price. And even when we look at the revenue without Warner Media segment, we can see the same trend starting from 2020 and actually continue to 2022. The operating expenses jumped in 2020 while the revenue dropped, which is not what we want to see, but we can say that this is the negative impact of COVID on this company, and hopefully this won't be repeated. The cost of revenue growth is reasonable. The gross margin is fluctuating, which make it hard to forecast next year margins. And if we look at the numbers without Warner Media segment, we can see that the gross margin percentage is negative, or in other words, AT&T spent more than the revenue generated. Scrolling down to see the free cash flow, I don't think you'll be surprised that it was also declining since 2020, and we have the same trend when we look at the free cash flow without Warner Media segment. Let me tell you, if you feel now that there is no consistency and things at AT&T are a little chaotic, the market is viewing AT&T in the same way. And in my opinion, this trend of decline might be the second concerning matter and the reason why the market is undervaluing this stock, that we will see by how much is undervalued later in this video. Moving on to the debt, it's about 34% of total assets when we look at the financial statements without the Warner Media segment, so it's still in the acceptable zone. And scrolling down to measure AT&T's ability to service the debt, we do that by using the times interest earned ratio, and in 2022 the earnings are only 3 times the interest expense, which is below the acceptable minimum amount for this ratio, that is 7 times. So in my opinion, this is the third concerning matter about AT&T that could justify why the stock is undervalued. Next, we want to look at the outstanding shares. There is a big jump in 2018 by about 18%, and that is justified by the acquisition of Warner Media business. But since 2019, the outstanding shares declining by about 2%. So we can say that's the first positive thing about AT&T, that they are not increasing their outstanding shares. The other positive thing about AT&T is that it's a dividend company, and up to 2021 they distributed about $2 per share, but in 2022 they only distributed $1.11, which is about half what they used to distribute, but in my opinion it still qualifies as a positive thing for AT&T. Now we can move on to the forecast part of this analysis report. To find the intrinsic value for 2023, we start by forecasting the revenue, then the total free cash flow, and the outstanding shares to know how much free cash flow per share AT&T will generate by the end of 2023. And part of this analysis is that we look for a consistent revenue ratio that we can use to forecast next year's revenue. And what I mean by a revenue ratio is a relation between the revenue and another item in the financial statements. In other words, what item in the financial statement does the revenue depends on and may influence next year's revenue. In this case, we will use the asset turnover ratio. This ratio tells us the relation between the revenue and the total assets. And as we can see here, it's very consistent since 2019. It ranged between 31% to 34% with an average of 32%. So we'll use 32% for the next year. And we know how much the total assets on the first day of 2023. It is reported on the 2022 balance sheet because it's prepared as of December 31st of 2022, and this figure is about 402 billion. Next is the free cash flow to revenue ratio, or how much of the revenue will be free cash flow. And if we look at the data without Warner Media segment, we can see that it ranges between 16 to 13% with an average of 15%. And in my opinion, we should use the average amount. The next item is the outstanding shares. And to be conservative, I will not assume that AT&T will continue to buy back some of their shares in 2023, and actually will assume that they will issue and sell 1% of 2022 outstanding shares. Also, we need a discount rate because we are forecasting the share price 1 year in the future, so we need to convert it to the present day value. The discount rate that we will be using is the interest rate on the 52 weeks Treasury bill debt security that is currently at 4.795%. It is important to check this rate every time you are running an analysis because it keeps changing. And the most accurate source to learn the current T-bill rate is the treasurydirect.gov website. This is the official website of the United States government to invest in the Treasury debt securities. So if you click on the marketable securities and then Treasury bills, then scroll down and click on the results of recent bill auctions, Then click on the 20 most recent auctions and scroll down to the first 52 weeks. This one here is the most recent rate at 4.795%. Going back to our analysis report, next we have the return on investment ratio. This ratio depends on you, your goals, and your risk tolerance. So I will start by using 5%. Now we have all 5 forecast keys to learn the intrinsic value of AT&T stock. And in my opinion, 2023 revenue will be about $128 billion and about $19 billion total free cash flow, which means $2.69 free cash flow per share. Using a 4.795% discount rate and 5% return on investment ratio, the intrinsic value of AT&T stock is $51.13. But remember, we had a number of concerning matters, so we should adjust the intrinsic value accordingly by increasing the only one item that we as investors get to decide, that is the return on investment ratio. Let me remind you quickly about the concerning matters. In my opinion, they are the leadership of the company and their ability to deliver growth, and I'm saying this because of the acquisition and separation of the Warner Media segment and business, the decline of revenue and free cash flow, and the third one is AT&T's ability to service the debt. These 3 concerning matters makes investors not sure whether AT&T will be around in the next 10 years. Of course, the decline in revenue and free cash flow could be temporary, and in 2023 or another future year, we can see a reverse back to growth. Or the decline continues in 2023 and the stock loses more value. In my opinion, AT&T is well established in the wireless and broadband industry, and if they focus their effort on what they do the best, they can easily grow their revenue and free cash flow. If we check the current stock price, we can see it's around $19. So if we adjust the return on investment to 13%, the intrinsic value will be close to the actual stock price. So we can say that now we learned the market return on investment on AT&T and learned that the market assumes that AT&T will be around for at least next 7 years, because with 13% return on investment, it takes 7 years to return the full initial investment. Another thing to keep in mind that this company is still a dividend company, and that's always an attractive option for many investors. Finally, I want to thank all the people who subscribe to support this channel and say that you are the reason that I continue to make more videos, and I hope you do the same thing if you haven't yet, so please subscribe and like this video.